introduction in a moment. Okay, I think we'll just kick off. If anyone misses out, then we'll share the recording. So thanks very much for joining us. This is a timely one today. We're coming up to the end of financial year, as probably everyone's aware. And our favourite topic is employee motivation and how that relates to equity incentives. And so one of the things that comes along with that is obviously the requirements around how you actually run those schemes, etc. And it's awesome to have one of the experts in the Aussie market, Stu, join us today to actually dive into all the details. I'll avoid all the technical questions; they all go straight to Stu. And then we've also got Shannon here if you've got technical questions about the Cake platform. I do just want to for those of you, we've got some existing Cake clients on the call today, which is awesome. If you don't know anything about Cake, I'll give you a little bit of background about what we do and why we exist. So yeah, we've been up and running since 2018. We're the dominant cap table platform in Australia, and then over the last 3 years, we've been pushing into the US. So in terms of new users coming onto the Cake platform, now more are coming in from the US than actually from Australia. But Australia remains, our biggest legacy business, if you like, and also a very important market to us. And then over the last couple of years, what's happened is when I started back at Cake back in 2020, we were mainly focused on early stage. And then over the last couple of years, we've really built out our offering and had a lot of clients coming on who are actually in that real scale up stage. And that's where we're really going to focus most of the conversation around what are your requirements for ESS reporting around those things today. As I said, our mission is driven by helping founders and helping startup team unlock the power of startup equity. And the thing that we're particularly passionate about is the employee equity component of that. But the bit that we particularly believe is one of the most powerful uses of your equity is getting the right team members on board, getting them aligned around your mission, because that's what is absolutely critical in terms of your success or otherwise. And so, just to give you some data points on that, and we'll come back to this in a little while, but by the time a startup hits $1 billion valuation, if they're in that $1 billion to $10 billion valuation range, then the median amount of equity that you've got allocated to your ESOP pool is actually 20%. Right. So at that stage, if you're a $5 billion valuation, then the median amount of value you're giving to your team is actually $1 billion, right? And at that stage, your team are probably the largest stakeholder, right? There's probably no individual investor that actually owns 20% of you, and you probably individual founders don't own 20% at that point in time. So it's important from a value perspective as well as the motivation piece. So that's why we're actually doing it today, to make sure that we're actually running it and we're ticking the box, dotting the I's and ticking all the boxes you need to do from an admin side and understanding how you do that. But we'll also delve a little bit, Shannon, I'll just show you quickly later on, is we've just done some significant enhancements to the platform to help really give you the tools so your team understand how ESOP works. They can actually really tap into the motivational value of the equity grants you're giving them as well. So we'll touch on that one as well. So with that, I'll hand over to you, Stu, to actually go through and you might want to give a little bit more context on yourself.
And I might just quickly share my screen. Hopefully this works. We're good to go. So thanks again, Cal, for having us along. Do really appreciate the opportunity to have a chat about ESS reporting. As an introduction, so Stuart Williams, I head up equity and incentives practice in Australia for Deloitte. And what that looks like is, anything to do with design, administration, the implementation of share plans, all the way from, startup territory through to ASX listed organisations. So we kind of see it all. ESS reporting to me is, yes, it's a compliance obligation, but if you don't get it right, it's one of those things that can diminish the value of a share plan, which otherwise is intended to really drive performance for a business. So again, thanks so much for having me. Today is really about giving you, a few nuggets, hopefully. So I won't go deep into the tax technical elements of it. There will be little bits and pieces on that, but it's really more about making sure that you're aware of the key issues that you need to be familiar with, highlighting some of the challenges that we're facing, and also hopefully giving you a little bit of insight as to the key risks that we see in performing this role for many organizations. So I think the starting point from my perspective is always understanding, are you actually in the ESS rules? Because if you're not in those rules, then you fall outside, you don't have any reporting obligations in relation to it. And the most common thing that I'm asked is, I've got this instrument, it's a little bit weird. I'm not really sure how it operates. It's operated by headquarters and we only get limited information here. But from my perspective, the key is, as a starting point, understanding what is the type of instrument, what does it look like, is it a right to shares, is it shares themselves? Have we done an analysis as to whether or not it's subject to upfront tax versus a deferral type arrangement? Have we got access to startup concessions? Do we have access to $1,000 concession as an example? So before you even start on the ESS reporting journey, from my point of view, the key is to understand your plan and understand the tax obligations in relation to it. When we talk about employee share schemes, it's really an ESS interest that's provided to an employee in respect of their employment and at a discount. There are many plans out there that have loan funding as an example, where you pay full market value for the instrument. They would usually fall outside of the ESS reporting provisions. Whereas if you've got rights to shares in a company, they generally do fall in. One of the key nuances around that is that for it to be considered an ESS interest, it does in fact need to be a share or a right to a share in a company of which you are an employee, or you need to be an employee of a subsidiary of that company. So if you've got, a sister entity, as an example, providing a share, that may not fall within these provisions. Just be aware of that. But as a starting point, get your fundamentals right before you even embark upon the ESS reporting journey. The second bit is it is in fact a separate obligation to STP, which many of you will be familiar with. So single touch payroll was brought in to assist with the facilitation of transparent data provision to the ATO in relation to salary and wages. But in Australia, we haven't chosen to go down the path of withholding, but for limited situations. And it's actually a separate obligation, the ESS reporting. So it doesn't go through your STP. We have found some organisations who have done that, and it's a pain, to be honest, to unwind. So make sure that if you are liaising with your payroll provider, or you're doing it in-house, that you're not passing these interests through STP. In terms of who needs to report, again, it's slightly unusual. You would think that it would be the employer who's required to report to the tax office, but that's not actually the case. The way it works is you look at the provider entity. And so when I talk about the provider, that is the company in which the shares or the rights to shares are provided, as opposed to the employing entity. So really basic example of that might be a US entity headco that has an Australian sub. In that scenario, if you get shares in the US entity, technically it's the US entity that has the obligation to file the ESS reporting. Luckily, the ATO have been somewhat concessionary and allowed the Australian entity to act as an agent in that regard. But just be mindful that for technical purposes, it is the provider and not necessarily the employer. In terms of what needs to be reported, it is really specific to individuals' personal facts and circumstances as to the ultimate outcome. What I would say is that, again, going back to that initial analysis, depending upon whether you are an upfront tax plan with concession or a deferred plan, it will go in different boxes within the ESS statement that needs to be provided to individuals, and also the report that needs to go to the tax office. So, where you place it in the statement depends upon the plan and the individual's personal facts and circumstances. And I guess from my side, the key to this is that you should only really be reporting the discounted amounts, the value of the discount that's been provided to the individual at the relevant taxing point. In terms of how to lodge, there are various mechanisms to get the information to the tax office. Luckily, it's a little bit simpler where you have fewer than 50 employees, because it can be lodged through the tax agent portal. For greater numbers than that, you either need to use a technology solution which is built in-house, which usually isn't something that we see, or alternatively a third-party provider who has already built that sort of technology. So again, what I would say is that when it comes to ESS reporting, if you do get it wrong, it does tend to create a significant amount of angst at the personal level when the participant goes to submit their tax return and it doesn't align with their expectations. So I always strongly advocate for the use of, or at least a review by a third party to make sure you've got it right. And even if you undertake that review in the first year and then perhaps limit the amount of review in later years, that's probably fine, but certainly get something done in the first year to make sure that you're getting it done appropriately. In terms of the actions and what is required, so there are two key elements. The 14th of July is the due date for delivery of the ESS statement to participants. So the ESS statement is sort of similar to, if you remember, our pay-as-you-go payment summaries that we used to have for our salary and wages side of things, or the income statement, I believe as it's now called. A similar sort of statement, albeit a separate obligation, needs to be sent to the participant outlining the discount that they've received that should be taxable in the relevant year. So for year ending 30 June 25, it'll be 14 July 25 that we've got a reporting obligation to participants. And then separately, the annual report, which is a synopsis of all of that information, all of the employees, the consolidation of that information that goes to the tax office by the 14th of August. It is important to note that there are penalties for late lodgement. So I haven't personally seen them imposed frequently. I've seen them imposed in very rare circumstances, but what I did want to call out was if you are a significant global entity, which looks to the turnover of your broader global group, there can be significant penalties that are imposed if you don't get your reporting done on time. And so always be mindful of those deadlines, but if you're an SGE, even more so, make sure that you're getting it done on time, or at least requesting an extension from the tax office. In terms of how you actually distribute the statements to employees, I get asked whether or not a paper distribution is required, and the answer to that is no. The tax office allows you to distribute things electronically. Again, third-party providers generally have a functionality or an ability to distribute statements to participants, or a mechanism to allow for you to do that through your intranet, as an example. So don't need to send paper statements, which is a plus. So in terms of some of the more nuanced elements of ESS reporting, one of the questions we get is around the valuation side of things. When it comes to valuations, unfortunately, what happens is that the tax office has provided a common law interpretation of market value. So they don't say you have to use this specific valuation technique in order to value your instruments. Whilst that's good in a way because it provides flexibility, it also provides a level of uncertainty. And so what we would say is when you are going through your ESS reporting, one of the keys is making sure that you're consistent in terms of the way that you operate your valuations. You don't really want to be seen to be picking and choosing valuations to potentially afford better tax outcomes for participants. The other thing to note too is that it doesn't necessarily need to be a third-party valuation. So quite often in the private company context, we would see people asking the question, do I need to get a third-party val? That is not the case. You can use direct evaluation so long as the valuation is being undertaken by someone who has the requisite skills, and it's formed on a reasonable basis and has the level of support behind it that you would expect for evaluation. So again, don't need to go down the third-party route, but obviously that provides for a little bit more clarity and certainty in respect of your outcomes for participants. The other thing on that is capital raises. Again, in the private context, when there's been a recent capital raise, we generally suggest that you don't, unless there's a good reason for it, don't materially vary the valuation for ESS reporting purposes relative to the cap raise, because obviously that's a value that theoretically is a market value at that point in time. Again, the further away from when you're valuing, the less relevance it has potentially. But again, just be mindful of cap raises. I think the other part too is around startup concessions. And so when it comes to the startup concessions, there are particular valuation methodologies that are, we call it the net tangible asset safe harbor values. There's the ruling that has been released by the tax office that allows you or affords you the ability to value based on net tangible assets where you're using a startup concession plan. Again, there are key criteria around that, around not being incorporated for 7 years and not having a recent cap raise more than 10 mil. But it's a really concessional valuation methodology and one that we would always explore in the context of a startup plan. So make sure you look at that. In terms of
you mentioned about the proximity of reporting in relation to a capital raise. Can you maybe elaborate a little bit on the pref shares versus ordinary shares and how you see that typically play out? Because even if you were reporting at the same time, the valuation applied across the different instruments might be a bit different.
I mean, I would always want to be looking at like for like. So in an employee share scheme context, again, this goes back to that initial point around understanding what you're granting at the start. So a pref share generally won't get any sort of concessional tax treatment from an Division 83A perspective. And so if you're going ords and ords, you would expect that whatever the ords, whatever the raise was done at for the ords element is what you use for ESS reporting purposes. You wouldn't seek to try and apply a pref share val across an ord, if that makes sense.
Yeah, but I guess a common scenario that we would see would be the raise is done on pref shares and then the actual team are getting the ordinary shares. So you're not like for like necessarily.
Yeah, I agree. In that sort of scenario, then I would say it has probably little to no relevance to the ord value, given it's a completely different instrument for tax purposes. So in that scenario, using the same valuation, I think would be fraught with risk.
Thanks for clarifying.
In terms of the reportable amount, what I really wanted to call out on this is the potential delta that can arise when we're reporting at the employer level relative to what gets included in an individual's personal tax return. So ESS reporting is intended to be an estimate of your taxable value. It's not what ultimately needs to go in the personal income tax return. And there are a multitude of reasons why that might be the case. You might have sold within 30 days and, as an employee, you weren't aware of that. That can adjust the amounts. Personal facts and circumstances to do with residency, as an example, might also change the reportable amount. So that's a long-winded way of saying don't be too concerned about a situation where an employee comes to you and says, I'm lodging a tax return and the amount that my accountant has calculated doesn't align with what has been reported to the tax office. Ideally, you do want those two to match because inevitably, if the ATO has on their records through the pre-fill an amount of X and Y is recorded in an individual's return, there is generally a level of scrutiny that is applied to that. But there's nothing that's saying that as an employer, you need to get it absolutely right. You need to get it right within the information that you have available to you as an employer. So payroll tax is a separate obligation altogether, but I thought it would be remiss of me not to touch on that when we're talking about ESS reporting. From my perspective, payroll tax is hand in glove whenever you're looking at your ESS reporting. The reason for that is that whilst the two sets of provisions may not align in terms of how they treat the instruments themselves, the timing of it is similar, and it's a real opportunity for you to consider your overarching obligations in respect of ESS. So, I always talk about payroll tax at the same time as ESS reporting. It's important to note too, touching on those differences, things such as indeterminate rights in the payroll tax context may not have application. In the income tax side of things may not have application in payroll tax. So you can't always assume that the value that you've picked up for ESS reporting purposes will slide nicely into your payroll tax return. And more often than not, it doesn't. And there are also differences to do with things like the startup concession is acknowledged for income tax purposes, generally not acknowledged. That net tangible assets valuation in some jurisdictions is not acknowledged for the payroll tax purposes. And things like cross-border arrangements, so where individuals are moving from one country to another while they're holding their share scheme interests, they can have material differences in payroll tax as well. So not trying to go into that in too much detail, suffice to say that when you're doing your ESS reporting, make sure you're also thinking about your payroll tax and getting your whoever's in charge of your payroll tax across it. And then the final bit I think I had was just around the startups in terms of their reporting. So I've quite frequently had companies come to me and say, oh, we've relied upon the startup concession plans, but nothing has actually been submitted to the tax office at the date of grant. And the problem with that is that when you do come to sell the asset, the ATO's records don't see that you have already crystallised the upfront tax position and then hold assets on a CGT basis going forward. So really important from my perspective that when you are doing your startup concession plans, that you are in fact including those amounts in your reports for the relevant year of grant. Anyway, Paula and myself, we both do this day in, day out, and are coming into our busy season. So do feel free to contact us. I know that, like I said, Cal will share the details with us. But I think from my perspective, that was it. More than happy to take any queries. I know that Shannon is going to do some demos now.
Stu, just before we move off, one of the things that I think a lot of the people online will be dealing with is not only Australia, but also grants to international employees as well. And you mentioned briefly in passing, but I don't know if you've got anything that you want to talk to a little bit about. Obviously, a lot of people are hiring in the US and that. So I don't know if you've got any tips on that, or UK would probably be another very common one we see.
Yeah, well, I think the first thing is to understand that there is withholding in those jurisdictions. So that's something new if you've been operating under the Australian regime, that unless you've failed to provide a tax file number, there is no withholding obligation. So one, making sure that it is, as opposed to Australia, including it in your payroll for those purposes. The other bit too is the rules, particularly in the US, are very specific about what can be offered and how they can be offered. And there are some really quite rigorous penalties if you don't meet those. So there's a provision 409A that for those of you in the US, will you be very familiar with. But it can seek to impose penalty taxes where your plan is structured in a way that the US doesn't like. So again, making sure you're doing your diligence before you're offering to mobile employees. And then I think the only other thing I would say is when it comes to regulatory side of it, so we have the Corps Act that looks after and I won't profess to be a lawyer, got to put a disclaimer in there. But we've got the Corps Act that dictates what you can do and disclosure requirements, all of those sorts of things. When you're going into other jurisdictions, they can be equally as complex as the Corps law requirements. So making sure that you're dealing with your regulatory aspect of it and not just the tax side of it would also be my other key aspect.
Great, that's some good points. And just so that people on the line know, things like your 409A valuations, and then also the structure of your grants for US employees. The Cake platform is set up to actually accommodate that. So understanding obviously that they're done differently here, whereas in the US it could be an NSO or an ISO or a RSU or RSA. It's different mechanisms are used in each of those markets, and then, as I said, different valuation requirements, and then even things like 83B elections and things like that. So we're set up to accommodate those across the different countries. So if you are doing it, make sure that you actually understand that. Don't just trot out an Aussie grant structure to employees over there, and then understand what your obligations are, and then we do have the capacity within the Cake platform to manage the different pools. Are there any questions?
Can a valuation prepared to satisfy US 409A, like by Cake's partners, be used to support a valuation determination for grants to Australian employees?
So again, I go back to that concept of what is reasonable. What is a common definition of market value? Now, 409A valuation may be sufficient, subject to how it has been undertaken and what metrics have been used. What I would say is that there are specific nuance in relation to the term market value for Australian purposes that mean that you have to disregard certain aspects of an instrument that prevent conversion to cash. And so if those elements have been taken into account in the 409A analysis, we would need to be careful that they were stripped out for Australian purposes. So the probably unhelpful answer to your question is perhaps, but we need to make sure that those Australian specific nuances have been taken into account.
Kind of what I've seen for customers using Cake is that your 409A valuation, for an early stage company can be sort of, maybe in the ballpark of 25% of maybe their latest raise, valuation on pref shares. So that might be, the what you'd actually expect just broadly around a range around those 409A valuations. And as I said, that's relative, probably pre-Series A. NTA valuation for an earlier stage company will often be a nominal amount, right? So if you chose to use a 409A versus an NTA valuation, if you are able to use startup concessions and use an NTA valuation, NTA might be more advantageous for earlier stage, and then obviously that can change as you go through your journey and as you actually get into scale-up space. So that's just the other factor that I would throw in there as well. Any other questions? I might hand over to Shannon just to show you, what we've built into the Cake platform to help streamline the reporting, and then a couple of other things in ours that I'm particularly keen just to actually show you quickly the employee app as well, which is a really important part of the whole process of getting the most value for your team out of those incentives as well.
So I'm just going to be giving a super quick run through of some of the tools that are available to you within the platform to help with your ESS reporting. And then, as Cal mentioned, I'll also jump into the employee portal to show you a couple of the tools available to your team in there to help with their motivation and incentivization through options. So, I'm just going to start really quickly here with giving you a bit of an overview of how an option pool actually looks in Cake, because this is going to build the foundation of your ESS reporting tool that you have access to within the platform. So this is a list of all of the outstanding or ongoing grants that this particular company has issued to their team over time. And so behind all of this, the platform is tracking things like multiple different vesting schedules, all of your different exercise prices, different grant dates over time. All of that is going to be tracked and managed for you automatically through here. And this is going to build the foundation for that ESS reporting tool that you'll have access to. So I'll just also show in here something Cal mentioned before, where you might have multiple different jurisdictions that your team is based over. As you're making a new option grant in here, those differences across jurisdictions are actually going to be built into this workflow. So it helps you to actually recognize or understand what may be a different requirement in a different jurisdiction like the US. Otherwise, for an Australian offer, super simple. When you're making a new offer, all you need to add in is who it is, who you're sending the offer to, how many options they're being granted in this particular grant. Then you've got your vesting schedule, which we try and keep as simple for you as we can if you're doing this for the first time. So we prompt you with what we see as an industry standard vesting schedule, but you can customize that as much as you want. And then the platform might be managing multiple different, and it can often be very complex vesting schedules, and it does that all for you automatically. And then this last piece down here is just around your exercise price. So that's where you get your valuation done to set that, whether it be through the NTA or another method. So this would then get you to a point where you're either sending an offer out for signing or a new offer out for signing through Cake, or you might be building out grants that you've made in the past. So at that point, you'll be putting in the grant date for that particular offer, or it will be dated for you once it has been accepted by the platform. So I just wanted to show you that to see, the underlying mechanisms that will then lead us into the reporting tool. So there's many different reports available to you within Cake. The one obviously that we're going to be focusing on is your ESS statement report. So in here, you'll have a drop down, which I hope you can actually see the drop down here, but it has multiple different financial years where you just simply select which financial year you're looking to do your reporting for. So if you're needing to go back and do anything or get this report on a historical basis, you can do that. Otherwise, it's going to prompt you with the most recent or current financial year. And all you need to do is click on export here, and that is going to download it into a CSV. And I'm just going to do a new screen share where I can show you what that report looks like. So the idea with this report is that it will have all of the details exported from the platform for grants made in that particular financial year. And the columns that you see here in the report will correspond with the form that you're then going back and doing the reporting to the ATO. So hopefully, for the most part, it's as easy as sort of copying and pasting the information into the form to do as part of your reporting. So you've got the employee name, where they are, if they had shares, part of a share plan, those would pull through here. You've got all of your options, so number of options that are required per grant, the market value of those on the date that the options were acquired, the exercise price and the option acquisition date. And then if you have any RSUs on issue, to do the same thing for that. And then you've got your unique plan ID, which is pulling through that information from the plans that you have set up in the platform as well. So really, really simple here. And the idea is that you would just basically copy and paste that into the form as part of the reporting. So I'm just going to jump back into the employee portal, unless Cal, you got anything to add to the reporting?
The only thing I'd just add to that is and Stuart mentioned it earlier, getting these things right early on is pretty important. And with the Cake journey, like our head co's Deloitte C Corp, Jason Calacanis and Lawrence Shinnick led our seed round, and the amount of focus on all the compliance elements in the US is another level to Australia. Make sure you get it right, because the bar in the US in particular is I think set quite a lot higher, and just there's a lot more focus on every element, and there's all those little nuances like in the US, when you do a grant, you need a board approval before you actually do the offer in the first place. But these things, pay attention to these things, because if you don't get them right, they will come back and bite you.
I'm just going to flip over quickly now to the employee portal and just show you some of the latest changes to what your employees have access to within here. It's very powerful for them, and there is a lot of education in here too to actually help them understand what it is that they've been granted in the company. So this homepage here just gives a snapshot to the employee in terms of what they have in the company. If they have got any other companies they've invested in that are using Cake, they'll be able to keep track of all of that through their portfolio. But if we start at the top here, just with these equity explainers, these are some really awesome new videos that the team have put together that goes through some of, I guess, the most frequently asked questions that we see employees ask. So explaining what vesting is, why do they have to pay to exercise their options, why is it options and not shares, and other jargon and things like that. So these are just super short videos intended to be super interactive for the employees to be able to come in, whether it's at the time of receiving their first option grant through the platform, or at any point really, if they want a refresher or maybe they're not super familiar with it prior to their employer starting to use Cake. So these are a new addition here, which hopefully will help the team understand a little bit more about what they have been offered. And then after they have accepted their offer in the company, they'll be able to go in at any point and see exactly where their grant is at. So if you're on a 4-year vesting schedule, they will be able to jump in here and see the full life cycle of their ESOP offer, when their options go into vest, what the exercise price is. If the company is keeping their latest company valuation up to date, they'll be able to see how much their options are worth based on the latest company valuation. So that might be their latest cap raise valuation that they've set in that company side. They can then translate that back to the employees to let them know what that means for their equity. And then the other really cool feature for the employees to be able to jump in and do is actually model out what their equity could be worth at different valuations in the future. So they can come in here, and let's just keep this nice and simple and only include one account here. So we can see that based on the current value of this particular company in my account here is set to 25 million. But if the employee wanted to jump in here and say, well, what if the company became a $100 million company? what does that then mean for my equity? So they can see the change based on the company's growth translated into what that means for their equity in the business. So for a lot of employees that maybe aren't as familiar with how this all works, it just helps to put a little bit of a dollar figure on there and just, give a little bit of meaning behind it so they can see just what it could mean for them, which, is pretty cool for them to be able to see. Other things that they've got in here, they've got their offers on the left-hand side here. So employees will also be able to review new offers, sign their offers through the platform. When they do receive a new offer, they'll have access to all of those tools that I just showed you. And when they are receiving a new grant through the platform, seeing what it's worth based on the current valuation, they can see before and after paying any exercise costs as well. So they give them both sides of that. And then they can always play with that equity calculator tool here. And then through to the point of signing it through the platform and then moving on to being able to keep up to date with the vesting events as they occur over the life cycle of the grant. And then a couple of extra little things here, just super quickly. The inbox. So if you are looking to use the platform to communicate with your stakeholders, in particular employees, this is a really great place to do that, where you can send updates that might relate back to their equity in the company. Again, just getting them a little bit more motivated by it and give them more visibility over it to make it more meaningful to them. And then last one is any documents. So if you are preparing any specific documentation that you need to share with your employees, or they might just be looking for a copy of their plan rules or their offer letter, all of that information will be in here. A really easy place for them to find it. Basically, anything that relates to their equity will all be uploaded and visible to them in their Cake portal. Great. So anything else, Cal, that you might want to add to that? Or otherwise, that will be pretty much it.
I think that's it. Are there any other questions before we go into wrapping up? Stu, did you have anything else?
No, I don't think so. All good from my side. Thanks, Cal.
Yeah, so look, thanks very much for joining the call today. Thanks, Stu, for running through the ESS reporting and the different structures and the obligations. One of the things that great to use the Cake platform, but you need the right advisors to actually help you through this journey as well. So, if you don't have the people around you, go and seek out someone like Stu from Deloitte or someone who can actually help you navigate through this. So make sure you do it properly. As I said, it's really important. If you're not on Cake already and you're looking for a cap table platform that builds in a lot of the tools that you need to take care of all this sort of stuff, then we do have a special offer, 10% off for your first 12 months on Cake. Just shoot us through an email and we'll be able to actually provide you a code for that one. Switching to Cake is easy if you are on an existing platform. We literally transfer, dozens of clients every week across. So we've got a very slick process, whether it be coming from spreadsheets or whether it be coming from another cap table provider. That's a really, really seamless process. It's free for you to be able to do that. And you've got, support team there to actually give you personalized support through that journey as well. And the last thing is, we always aim to be startup friendly in terms of our pricing and transparency, et cetera. So, the 10% discount's great, but you also want to make sure that you're dealing with someone who is going to be consistent and fair in their pricing ongoing. And that's something that we really aim to do. Thanks very much for joining us on the call today. Thanks to Stu, thanks to Shannon, and thanks for Tila for all your work lining it up. If you have any questions, feel free to hit us up. After this, we'll send out a copy of the video and also the slides here as well. If you have any questions, feel free to, Stu on the technical side of it. Shannon and the CS team can help you if you are on the Cake platform, whether you want to come on or you're an existing user and you've got questions about this, feel free to reach out. So thanks very much for joining us. I really appreciate it, and see you at the next one. Cheers, everybody.